Hello and welcome to How I Built This Resilience edition from NPR. This is where we're talking with entrepreneurs about how they're building resilience during this very challenging time. In the window next to me is Jennifer Neundorfer. She's the co-founder and managing partner of January Ventures. That's an investment firm focused on tech startups founded by women and people of color. Jennifer, welcome.
Thanks, Guy. It's great to be here.
And before we get into it, please do submit any questions you have for Jennifer about investing, VC, whatever they may be, via Facebook or Twitter or YouTube or LinkedIn or however you are watching. Jennifer, tell me a little bit about January Ventures.
Yeah, so at January, we are building a different type of venture fund to serve the people that we believe will be the successful founders of the future. And so the irony, Guy, is that although venture invests in innovation, the model is actually pretty traditional and slow to innovate. And that's what we are addressing at January. And so our focus is on investing in, as you said, women and underrepresented founders. And our belief is that those founders are going to be the great founders of the future. And what we're doing differently is really building a venture firm that is designed around access and transparency. That's not what venture has traditionally been known for. And it's what has really underserved women and underrepresented founders. And so we make it very easy for founders to pitch us and find us. And everything that we do is focused on removing friction for those founders at the earliest stage.
And what type of startups do you look for?
Yeah, we invest primarily in tech-enabled software businesses. So we are investing in companies that we believe can be high-growth, scalable companies that are going to be capital efficient. And one of the things that I talk about a lot is venture capital is not right for every business, and not every founder should feel like they have to go out and raise outside capital. But the companies that we are investing in, we are investing the capital early and then are looking for outsized returns. So we're looking for companies that can go on to be $100 million, billion-dollar companies and really buyers that generate returns for our fund.
And you invest in the seed stage, in the early stages?
Yeah, we invest at the pre-seed and seed stage. And one of the reasons that we do that, Guy, is when we started January, we did some early research. And there had been a lot of data talking about how little venture dollars women receive. In 2019, female-only teams received just 3% of venture dollars. And if a woman happened to have a male co-founder, she received 11% of venture dollars. But what we found in our data, as we looked just at the earliest stage, is that there's not only a gender gap, but it really starts early. So for every dollar that a male founder raises at the pre-seed or seed stage, a woman raises 38 cents, and a Black woman raises just 2 cents. And so that is really where we are focused at January, because as you can imagine, $1 versus 38 cents on the dollar versus 2 cents on the dollar, many of those founders are handicapped from the start. And so our focus is on getting them the capital and resources that they need to really generate momentum for their business and get to that scalable growth curve.
How large is your fund right now?
Yeah, we're deploying out of a $20 million fund and have really focused the size of that fund to be able to write checks for founders at the pre-seed and seed stage. And so, we're typically writing checks that range up to, $500,000 plus, because we're investing at a stage when founders are raising, $250,000, $300,000, up to $1 million, and really at those earliest stages, and often the first capital in.
And who are your investors?
Our investors range. So many of them are the typical investors that you would expect to see in other venture capital funds. So those are family offices, high net worth individuals, and some institutions and foundations. But from the beginning, my partner Marin and I wanted to be very deliberate about who our investors, who our limited partners were, because so much of the traditional venture model has relied on a very small set of investors or limited partners and has reinforced this flywheel around making that small group very wealthy, but it's been a pretty limited pool. And so what we have done in both of our funds is proactively reduce the barriers for non-traditional investors to invest in our fund, whether that is a founder who is just beginning to accumulate capital and wealth and may not have a lot of liquidity, and finding ways for them to participate, or pitching LPs who fall outside of the traditional circuit that most funds pitch, whether it's by geography, race, ethnicity. We've really tried to work hard to diversify our LP base.
How do you find startups to invest in?
It's a great question, Guy, and it's something that Maren and I spend a lot of our time doing. I mentioned that venture has been so long, really inaccessible to most founders, and a lot of that is because many venture capitalists, they rely on their network to source deals, and that's fine. But most of the people that are in someone's network look or are similar to, have similar characteristics to that person. We hear a lot of VCs talk about the test, which is, can a founder get a warm intro to them? And if so, then they're willing to consider taking a meeting. We turned that on our head at January. And so from the start, from the day that we launched, we have been open to cold pitches. And when we went out with that, many of our peers told us that we were crazy. There was, we weren't going to see great pitches. There was no way that we could handle that sort of volume. And we were pretty overwhelmed when we launched in October of 2018. We saw 400 pitches within the first week. And so very quickly, we developed, we leveraged technology to develop a scalable way to review those deals. We're very generous with the first 30-minute meeting. Maren and I want to be the first people that are meeting these founders, right? We want to be the ones who are judging whether they are a fit for our thesis. And then we have a higher bar for who fits into, who we spend time with, who we do diligence on, and ultimately invest in. Because the nature of our business is there's a very wide top of funnel. And in any given fund, we're making 25 to 30 investments. So it's a pretty Darwinian process, but we're very deliberate from the start that our top of funnel is wide. And so that is the cold pitches. It's also who we work with as partners. And, given the founder base that we are investing in, we don't want to rely on them finding us. We have a strong brand, and many founders do, but we're deliberate in the organizations that we work with to make sure that we are reaching founders that really fit that underrepresented mold, and telling them that our light is on and we want to be the fund of choice for them.
So tell me about some of the startups in your portfolio.
Yeah, this is the part that I love talking about. It's sort of like talking about your kids. And it's hard to pick just one, but I'll give you, a sense for some of them. One of the things, Guy, you asked sort of what we invest in, and we typically invest in startups that are focusing on sort of the future of work broadly defined. So how companies are working, how they are productive, who they're hiring, how they're training. We do a lot in digital health, and we also invest in sort of embedded financial services. But the theme throughout that is we are investing in problems that we believe are big and we really care about solving. So we're not the fund that is going to invest in a company that sort of has on-demand Michelin chefs, but we're really focused on investing in companies that are addressing big, broad problems that are going to shape the future of this world and the future of our country. And so one of those founders that is really doing this is a founder, Julia Collins, who is the CEO of a company called Planet Forward. And Julia is building a regenerative supply chain for sustainable foods. And she's doing this both, through technology, but is also launching a brand to be the first showcase of how the CPG industry can really make sustainability core to what it's doing. Julia is a founder who has deep roots in both food and sustainability, and great founder market fit. That's something that we look for a lot. And what we've seen in the past 6 months is that consumers, between being at home and suddenly really caring about what food they eat, and then all of the very visible events in the last couple months around climate change, consumers are really starting to there's an acceleration in consumers' awareness of climate-friendly foods, and being conscious of the choices that they make and wanting those to be sustainable. Another one of our founders is a woman named.
Sorry.
Yeah.
Well, can you kind of explain just in plain language, what does a regenerative supply chain mean? I mean, I know what a supply chain means. I know what regenerative means.
Yeah,
Um,
yeah.
is it you know getting food from the farm to the end market in a sustainable way with electric vehicles? Like, tell me what does it actually mean?
That's a great question, Guy. It's really about the ingredients and where brands and CPG companies are sourcing the ingredients for their food. So it's less about the delivery, although they will take into account, trying to create a supply chain that is more local. But as an example, with Planet Forward's platform, if I were a snack brand, I could go in and list my ingredients, and they would basically evaluate the sustainability and, on a number of different metrics, including the carbon footprint, including how those ingredients were actually farmed, and then be able to suggest alternative sources and whether it's, a different farmer, a different type of ingredient that will have the same impact, so that I as a brand could make those adjustments and make a more sustainable and regenerative food product.
Right. So if you were looking for palm oil, for example, this platform could say, hey, this is a better place to source your palm oil from.
That's exactly right. And they are really the first ones to do that. And in the similar way that organics has grown up to be a fully, full-blown supply chain and products that consumers recognize, they are leading that same wave for regenerative and sustainable foods.
Got it.
One other company that I'll highlight is a company called Kinside, a founder, Shadia Segala, who is a repeat founder. And with Kinside, the problem that she's solving is how employers and employees find childcare. And so what Kinside set out to do was create an employee benefit around childcare. And I mentioned Shadia because she's an amazingly charismatic entrepreneur. She's a great leader. She had built a great company. But we got to March and the world shut down. And suddenly no one was sending their kids anywhere. Everyone was locked at home. And so for this moment, it's suddenly a lot of her business was in question. And like many of our founders, Shadia saw the long-term opportunity for her business and has really been a leader in the short term, bringing to light the fact that although, for many months parents weren't able to send their children outside of the house, for employees and for employers and corporations, that's a huge issue. And this looming childcare crisis that is on the horizon of parents not being able to get back to work because either they can't send their children in person or all of these childcare providers, many of them have gone out of business. She's really become a thought leader and is started, during COVID while people were locked at home, laid the foundation for now what the business is doing is getting employees back to work and making sure that parents can find childcare, even if it's not where they were sending their child prior to the pandemic.
Are you seeing? I mean, there are a lot of has been a lot of momentum. I don't know if it's real or not, but there certainly have been some VC firms that have announced more support for Black and Latinx startup founders, and Andreessen Horowitz announced a fund, and it's unclear what that will mean. But is it? I mean, is it? Are you finding lots and lots of Black and Latinx and other founders of color, kind of coming to you with ideas? Are you seeing a real kind of surge in new ideas coming from founders of color?
Guy, I would say that it's to us that supply of Black, Latinx, LGBTQ, so many different diverse groups, that supply has always been there. And so for us, it's not that we're suddenly seeing a new surge now. I think that we are seeing, at sort of the industry level, that it is a conversation that more people are having. So there's more visibility around the conversation. But, this taps into our whole belief for starting January. Those founders have always been there. And so much of what we are doing is trying to make venture accessible to those founders, because for so long it hasn't been. And we applaud the efforts of others in the industry. The more people that are deploying capital into diverse founders, like that's what this is going to take for, really we will have all done our jobs if these diverse founders that we are seeing build great businesses, if their names become synonymous with the Bill Gates and the Mark Zuckerbergs of the world. That's when we will know that we have been successful.
On how I built this, I would say about 2/3 of the people we've had on the show, on the main show every Monday for the last 4 years, I'd say about 2/3 of them have said, don't take VC money. That's been their advice, that they actually, some people regret it. Some people are really happy that they went after institutional or family foundations or figured out a way to bootstrap. Not always easy. And the knock that I hear on the show from so many founders who didn't take VC money is that, VCs expect a 10x return within 10 years, and it forces entrepreneurs to focus on scale and only scale. Do you think that's a fair criticism?
In some cases, yes. And I think my main piece of advice to founders, and a conversation that I always have with founders as part of meeting them, is aligning the incentives of the capital with the vision and motivation of the founder. There is nothing worse, and many of your guests have talked about it, than having friction and having those incentives be at odds. Because the reality is, you're right, the venture model requires a really high return threshold. This is, a risky asset class, and so investors and our LPs expect a huge return. So I do think that is the right question for founders to ask themselves out of the gate. But I think the second question, if founders are interested in venture capital, is to really do the diligence on the fund and the partner who is leading that deal. Because there's just a wide variety of outcomes that funds are shooting towards, and stylistic differences between partners. And so that, we always encourage our founders to do diligence on us, because that really will make or break the quality of that experience, and I think will shape how the founder feels on the flip side of having taken venture money.
Jennifer, do you think, I get asked this question a lot, and I have my answer to this question. We're in the middle of a global pandemic, and I think something like 50% of the Fortune 500 companies today started during economic downturns. Do you think now is a good time to start a business?
Another great question, Guy. I think that at the macro level, there will be great companies that are born out of the constraints of this moment. And we've seen that historically. I think that will happen again. But that said, it doesn't make it any easier for prospective founders to make the leap, because the reality is it's actually quite hard to raise money right now. So right after COVID hit in April, we did a survey of our early stage founders. We talked to 250 early stage founders in our community, and it was interesting. 50% felt that COVID would negatively impact their business, but 50% had already pivoted, which just speaks to the nimbleness of early stage founders and the fact that, in a certain sense, COVID has put everyone back at the starting line and sort of reset the opportunities for early stage startups. But the more interesting point, Guy, was that 80% of the founders said they were fundraising, and 70% of the founders said their experience was that funding opportunities were drying up. And so with that context, it's very easy for, venture capitalists like me to sit here and say, now's the time to build, go out, great companies are going to be born. But as a founder, considering making that leap, those are really, that's a scary environment to just leap right into. And so, our response to that was to launch, to launch new initiatives to really make it easy for founders to fundraise at scale. One of the things we did and continue to do is an event called Pitch Collective. We have all these inbound cold pitches, right, where we're meeting founders who aren't in our network. But we realized that, they're just pitching us. And at the end of the day, that's not that scalable because they're going to have 20 to 50 meetings with venture capitalists. And so what we've done is gather 10 to 15 other GPs, other venture funds to join us for those pitches. And it's a small thing, but it's one of the examples that we are doing to just try to take that friction out and really try to support founders, because there's a lot of opportunity, but it's also a really challenging time to build a business.
I'm going to take a question from Facebook. This is from Deborah Gladney. She writes, she's in Wichita, Kansas. Hi, hello, Deborah. She writes, as a Black female founder, it's great to see capital being deployed to help minority founders, but bias still exists. So what are VCs, in your case, what are you doing to combat the bias that we all know exists, the systemic bias?
Yeah, Deborah, that's such a great question. And I love that you're calling in from Kansas, because I was in Cleveland, Ohio for 8 years. It's actually where I began my venture career, which is a different story. But one of the things that we're doing, Deborah, is really taking a hard look and being intentional at the questions that we ask founders. So one of the ways that bias can show up is in the things that venture capitalists ask founders when they're in a diligence meeting. And so we've taken a really hard look at that, and have actually begun to script out the key questions that we want to cover, so that they are the same, whether it is, a white woman, a Black man, a Black woman, whoever it is, and also regardless of the geography, because I think there's bias along gender and racial lines. But, I mentioned that I have invested now both on the coast and in the middle of the country. And there's a lot of bias that we see in terms of the questions that founders from the middle of the country get asked versus founders on the coast.
Yeah, I remember we interviewed Toby Ledke of Shopify, and when he initially looked for funding, everybody told him to leave Ottawa and to move his operations to Silicon Valley, and he didn't want to. It's a multi-billion-dollar business today. So what advice do you have for up-and-coming entrepreneurs who are looking to pitch? What stands out to you in a pitch?
Yeah, we see so many pitches, and it is hard to make a pitch stand out. But I think founders who in this new world, and it's even harder to make a pitch stand out when you're doing it via Zoom. You don't know what the person who's watching the pitch is doing on the other end.
Yeah.
And so we encourage our founders to really invest in nailing that virtual pitch. And one thing that we really love is when founders do, whether it's using Loom or some other screen recording, and they send us a pitch that is not just a slide deck, it's them delivering the pitch. And there's nothing better than that. You have to be charismatic. You need to get the points across. But then we hear how the founder would tell their story rather than flipping through on a static PowerPoint. I think so that's one way that we really encourage founders to stand out. And then, I think it's, whether it's virtual today or hopefully in person at some point, it's all about running a tight fundraising process. And so being clear about who it is that you think you may be a good fit for, going after them hard, and creating some urgency and momentum around the raise. Because frankly, the scarcest resource in all of this is a founder's time. And every single fundraising pitch eats up their time. It's something that we are really conscious of in our process, not to have 10 meetings with a founder because they don't have that type of time.
Yeah.
So, I think being protective of your time as a founder and running a tight process, getting to a quick no, if that's where it's going, don't be afraid of that, but really leaning in hard to the ones where there does seem to be a fit. And then, Guy, I mentioned this before, but really doing diligence on your investors. So much of the fundraising dynamic is set up for funds and GPs to diligence founders, but it really should be a two-way street, because you're giving these people ownership in your company, and make sure that they are willing, that we as venture capitalists are willing to work for that ownership and that we're really going to provide value.
How much of the decisions to back a company are based on your intuition, and how much of it is based on just doing the math and plugging in the numbers into a spreadsheet and looking at the result?
Yeah. We look for three things when we're looking at founders, and it's a bit of a mix. So the first is a big market. Given what we talked about with the math on making a venture investment and then a venture fund work, we need to believe that the company is going after a big market or that they're going to create a big market. So that's sort of the first thing. The second that we look for are evangelist customers. So we invest really early. We don't expect there to be a lot of customers, but it's easy to stand up some sort of MVP of a product, right? The first version is probably going to be ugly. It may be held together on the back end manually with a little bit of duct tape, but we like to see someone who has used the product and is wild about it. But then the third place, Guy, that we spend most of our time is on the founder and the team, and getting to a place where we believe that that team is differentially suited to build this company and to be successful. So sometimes it's unique insight that they have. Sometimes it's really differentiated experience. Sometimes it's just, sort of a magnetic leader that can make things happen. And that is, to a certain extent, that is a gut feel, but we try to put data into it. We spend a lot of time doing reference calls so that it isn't, Maren and I sitting here and we have a call with someone and we have a good gut feel and we say yes. We really try to check our own gut feel and our instincts with data from people who know them well.
Great. Jennifer Neundorfer of January Ventures, thank you so much for joining us.
Thank you. It was great to be here, Guy.
Thank you all for joining us. Just a couple of quick announcements. We have a brand new episode dropped yesterday. The story of Health Aid Kombucha started out as a hair loss treatment and turned into a $100 million kombucha company. Also, just a reminder, How I Built This Book is now out. If you love this show, if you love what we do, if we bring you value, if you've learned lots of practical advice and lessons, please support us and go check out this book. It's the price of a few cups of coffee. We will be back here on Friday with another edition of How I Built This Resilience. Jennifer, thank you again, and thank you everybody for watching.
Thanks so much, Guy. Thanks for the questions as well.